Great pleasure to bring on board Mr. Murali Ramakrishnan, Managing Director of South Indian Bank. Mr. Ramakrishnan, good morning. Thank you for joining us. It's your first time, at least on ET now, on the morning show, so a warm welcome. South Indian Bank is revamping its business model. They're trying to reboot and regain their old mojo. Walk us through how things have changed for South Indian Bank post-September 2020, ever since when you took over.
I would put the changes into three broad areas. One on the structure of the bank. The way we were structured earlier was very different from the way we went about restructuring the bank. Today, if you ask me how we have done on the liability side, is that we have got a branch structure, and branches have a cluster structure between branch and regional heads, and there is we have 18 regions across the country covering about 927 branches. So there is a very clear line of authority in terms of a branch headed by a branch manager, reporting into a cluster, and cluster head reporting to a regional head, and regional head reporting to head of branch banking, which actually brought in a lot of sharp focus on the way we carry out liability business and all those business which were carried out from the branch distribution network. On the asset side, like the way we have, like the way many of the large retail banks have structured themselves, we have also brought in a vertical structure for all the retail, all the asset sides. So we have today dedicated corporate banking group, dedicated SME group, dedicated agri group. In retail, we have home loan and LAP as a separate line of business. We have credit card, personal loan, auto. All these have been brought in like a vertical structure, which again has brought in tremendous focus on how we need to grow these businesses. So this is on the structure side. Second, I would say is a huge focus on quality underwriting and quality of sourcing. One of the things which actually plagued the bank in the past was the huge NPA levels and the huge hit on the provisioning which the bank had to take in order to manage the portfolio. So the only way we could have resurrected the situation is to completely focus on quality sourcing and quality underwriting. So we have done a lot of changes, initiatives in the area of sourcing as well as in underwriting. Just to name a couple of them, we have brought in credit models for underwriting retail products like personal loan, home loan, etc. Similarly, in MSME, we have brought in credit model built for a small end of MSME where the ticket size are generally up to 2 crores. And similarly, in the corporate side, we are focused on really good quality corporates with a rating of A and above. And I'm happy to say that almost 95% of the new acquisition which we have done in the corporate or towards the corporates which have been rated A and above. So across every area, I mean, we have brought in a lot of focus on learning and development. We have brought in a lot of focus on analytics. These are some of the new divisions which were formed in the last 18 months and which has brought in tremendous focus on various areas which we wanted to grow.
Okay. Where do you see your book size moving in the next 3 years?
Currently, we are at about 70,000 crores as of Q3. And given the fact that the market is a little sluggish in terms of advances growth post-October, we would probably end the year with a growth about 10 to 12%, 12 to 13% kind of growth from last year numbers. We are targeting about 72,000 crores by this March end. Next year, the plan is to take it to 83 to 85,000 crores kind of book size, and a subsequent year we would want to target 1 lakh crore of assets. See, originally we came up with a strategy plan where we wanted to reach 1 lakh crores by March 24, but due to 2 years of COVID and the various changes which we had to do, we have pushed the entire plan by 1 year. So we are expecting 1 lakh crore asset size to be reached by March 25. But the plan which I have is on any day, I would focus on quality over growth. So if it means that we are getting good quality assets for growing the book in the way I'm saying, we will probably focus on that. Otherwise, we'll obviously give priority to quality over growth.
Would you be focusing on the retail side or the wholesale side to build your book?
We are actually fairly well poised in all the areas. So today, even if I look at the composition of my book, it's equally poised between wholesale, MSME and retail. So the focus is to grow continuously on retail, MSME in order to diversify the risk and to really cash in on the opportunities which are arising in the corporate and the wholesale banking side. So the focus will be to grow quality assets irrespective of whichever business line it comes from. Obviously, to overall manage the risk, we would probably diversify the risk through growth through quality, the growth through MSME and retail.
Your CASA ratios have gone up. That's commendable. From about 25% to about 30% plus. 28 has become 34 as per the December data. Do you see this kind of growth sustaining?
Actually, CASA growth has been pretty good for us in the past, I would say 1.5 years or so. We have consistently grown from, as you said, from 25% level to 33, 34% kind of level. But what we are seeing now is a little sluggish growth in the CASA side, primarily due to the fact that today deposit holders and as well as investors have opportunities to keep their money in the other areas where they will be able to earn a little higher income. So we are actually finding the trend of many of the people who hold CASA shifting their funds into creating deposits. So we are seeing growth in the deposit side. To that extent, CASA has not been showing growth as it used to show. But we are fairly confident that we'll be able to sustain this level for a quarter or two, and then we will definitely aim to grow because we are seeing a lot of traction happening in all the four engines of CASA growth, whether it's NR or whether it's government banking or task as well as retail. There are a lot of new initiatives which we have taken, which we are hoping that when liquidity eases a bit, we'll be able to see growth coming back into CASA. Our target is to reach 35% kind of CASA level by next March 24.
Without raising capital, do you think you will be able to build a strong liability franchise that you don't need capital to double your balance sheet in 3 years?
Currently, we are having a very close watch on our capital adequacy. I'm happy to say that our capital adequacy used to be at sub 13% level. We have brought it up to 16.25% level. This has happened primarily due to two reasons. One is we went about raising capital of 240 crores in March 21 by bringing in good quality institutional investors. At the same time, we have churned our portfolio for a better quality, which has resulted in capital adequacy going up to 16.25%. This year, without taking into account this year's profitability, this is the first, I would say, normal year for us because we were doing a lot of changes and restructuring over the last couple of years. This is the first normal year where we are seeing consistent growth in our profits, and with the internal accruals happening quarter after quarter, we are hoping that our capital adequacy will be reasonably good by March. We will again take a stock in April and to see, depending on the growth plans which we have for the coming year, we will see whether we need to raise capital and in what form and in how much, etc. That will be decided in consultation with the board.
How will you ensure that the NPA challenges which had hit you in the last cycle, they are not repeated again? Because in India, sir, it's very easy to grow. We are a capital starved country. You can do lending very easily. You can build a liability franchise because you are a old South Indian bank. It's very easy to create a liability franchise. But the problem is when you start lending, how will you differentiate yourself in terms of the previous NPA problems which had hit the bank?
Yeah, I think the important thing is what hit the bank in the past is something which we need to learn from, and obviously we shouldn't be repeating such mistakes again. I think if you ask me, the key issues were in terms of quality sourcing, and in terms of quality underwriting. Earlier, the model was that a branch was the point where all the business were done. So clearly, you had the same set of individuals handling corporate case or a retail case or SME case. So there wasn't any, I would say, for lack of better word, expertise in these specific nuances of these businesses. As you know, all these businesses have certain specific nuances. So we need people who are who think through this all through the day and who are actually focusing on customers who belong to this segment. The understanding of such customers, understanding of the business model is very crucial. That is on one side. So with the way we have structured our bank now, both in the assets and liability side, we believe that we are able to bring in that sharper focus on each of this business line. Today, I'm happy to say that each of our vertical resources are fairly well versed with the nuances of this business. I mean, we have a very young workforce. Our average age is 32. So you know that people of that age group are easily adaptable. They can learn many things. And so they are able to now clearly differentiate a good quality deal from a not so good quality deal. That's on one side. Second side, we have actually brought in a lot of science into the way we underwrite. I mean, having had experience in managing SME, retail and corporate book in my earlier stint in ICICI Bank, we have brought in a lot of such modern practices into this bank. We are using extensively analytics today, and we have built in credit models. We have completely digitized some of these businesses. So today, more than ever, you have a lot of secondary data available. You can use a bureau data, you can use a CMR, you can build credit model, you can do predictive analytics. we are using analytics extensively in the asset side, liability side, in collection side. So with all this, I believe that today the team is fairly well versed and are clearly aware of what is to be done, and the message that quality has to be the primary focus has reached the last person in the bank today. I mean, this is one of the things which I did very, very consciously, because unless we bring the entire bank into on board on this, it's not easy to maintain a quality of the portfolio. So in every communication which I've been doing consistently, at least once a month to the entire bank, I brought in this focus of quality. And today I'm happy to say that even when I travel to far-flung branches, you can see the branch resources talking the same language which I used to communicate to them. So I believe that it's a cultural change which has happened, and given this cultural change, it's not natural. I mean, it's not very easy for somebody to go back and do the old way of doing things. So I believe that we will be able to sustain this, and of course, thanks to economy, if it continues to do reasonably well, we believe that we'll be able to pick and choose the right kind of cases which should be onboarded into our book. So, of course, it's a continuous game, and there is no, we cannot let our control loose on the monitoring. We need to be looking at pre-delinquency measures. We need to look at monitoring on a continuous basis. So, a lot of efforts have been put in terms of managing the portfolio, etc. So,
all right, Mr. Ramakrishnan, appreciate your time. So glad you could join us, and it was really a pleasure to have you on the show.
Thank you so much. Thanks for the opportunity. Thank you so much.